Again, it's important to note that the franchise tax is not a tax on income, which violates the Texas Constitution, but a tax on the margin. This can have some drastic effects on small businesses, as Jim and Blaine can attest to.
So far what I'm finding is that even after you apply the formulas, and there are different formulas there's a few different ways that you can calculate it, but so far every way that we've done it I've ended up having to pay money, and you might say, okay, well, it's a tax, you're supposed to be paying money, right? Well, the thing is this business has not made money, this business has lost money, and yet each year since they've made these changes to franchise tax, I've had to pay taxes. So last year this business lost $162,000, and I paid $5,900 in franchise tax. To me, that just doesn't make any sense. And so I think there has to be some sort of mechanism to tie it to profitability, following generally accepted accounting principles. I mean, you can't just wing it and come up with any numbers you want, because obviously I understand that there was some accountant who figured out how to make the Titanic look like it didn't make money. You know, the movie, and so not the boat. I don't think the boat did so well, but I think the movie did okay. And so I think that the franchise tax needs to be modified in order to deal with low margin businesses like grocery stores. Also, I think it needs to be modified to deal with businesses that are actually losing money, because my options in this business are I can continue to feed it if I want to, or I can shut it down. If I shut it down, there are no taxes to be gained. And so it seems like it behooves the state to give businesses an opportunity to make money so that they have an opportunity to continue to pay in so many other ways.
The worst thing about the Texas franchise tax, okay, is that let's say you have, let's say we're in 2011, 2011's over with, and you had sales of over $600,000. Okay, so that means you basically have to, generally speaking, you got to file the long form, which includes all the, the different calculations: cost of goods sold, 70% revenue, the compensation, or you could do the EZ calculation. You're now subject to that, okay? But let's say you gross $1 million, you're up over $600,000. You have to file one of these forms. But let's say you have a loss at the end of the year. Let's say you don't have net income, you have a net loss. It does not matter. You still have to file the form and pay the tax, even if you've lost money. That is the most unfair thing about the franchise tax return. But there's one of the guys that helped write this law. Somebody was asking him that. Well, how can this is really net income that you're taxing? And his explanation was it's a one-liner. It was something along the lines of it can't be net income that we're taxing you on. Okay, because if you have a net loss, you still have to pay. That was his justification for the whole rule.
In talking to small business owners who helped with this program, we discovered that they have much in the way of advice for people in similar situations to them in dealing with this tax.
I think if you're running a business, you've got to use a lot of outside help. You cannot be an expert in everything that you need to be an expert in. I mean, you're not going to be an expert in the legal issues that you're going to need to deal with. You're not going to be an expert in the accounting issues that you're going to need to deal with. Whatever it is that you do that makes you money, do that. Everything else you should have other people doing, because, I mean, if you're running a business and your business is making money because you're selling stuff, every minute that you spend trying to figure out how to take a few dollars off the table that you could have just paid to an accountant to have the accountant solve that problem for you is now time that you spent away from selling stuff, which is what made you money in the first place. So do what you do, make your money, have the pros do what they do, and I think in the end you'll end up a lot better off than if you try and do it all yourself.
Before you ever set up a company, an entity in the state of Texas or any other state, you need to go talk to a CPA, a tax accountant, first. It's the first thing you need to do, so that you can understand what the result is going to be as a result of setting up an entity that's a corporation or an LLC or whatever it is. What's the tax implication going to be from the IRS perspective, from the Texas franchise tax perspective, from the Texas Workforce Commission, all these different things, all these different regulations. What is the implication going to be? Because the reality is that at the end of the day, you're not going to want to be taxed as a sole proprietor, as a DBA. You're not going to want to be taxed as general partnership. The more successful you get, there's some things you can do on the front end and help with your understanding that, well, when we get to become more successful, we can incorporate or we can do X, Y, or Z. And oh, by the way, these are the things that are carried along with it. Okay? Now you're subject to the franchise tax. and where you've never had to pay it in the past, now all of a sudden you're going to have to pay for it, okay?
We hope this has been insightful in helping you understand this very difficult topic. Always remember to seek out help and use your resources and network to help you get ahead. Thank you for watching Mace Business News. I've been Sean.
And I've been Bridget. Keep it tuned here for more breaking business topics to help you stay a step ahead.
Thanks and gig 'em.